Welcome back to Squawk Box. We are on the trading floor of Paul Tudor Jones's firm, continuing our conversation with him. Just finished up talking about Just Capital, but
a day of celebration for great companies doing just things.
I also wanted to talk to you about what I think is a relatively bold call that you have about what the Fed may or may not do when it comes to hikes. What do you think is going to happen?
Well, central banks always, generally speaking, managed by looking in the rearview mirror. So they're always looking at data that's old. The whole forward guidance thing locks them into these kind of intractable paths it's very difficult for them to deviate from. And that's probably not the best way to manage an economy, but it's when you're driving that many different stakeholders and you have so much momentum, it's very hard for them to change. What's different this time is that I started out as a cotton trader, so commodities, you know, I was trading. That was the very first thing. There were no financial futures, or there's certainly no stock index futures when I first started, and other financial futures on interest rates had just begun. My point being, I always look at commodities because they're a great leading indicator for the economy. So right now we have the Goldman Sachs Commodity Index down about 15% over the past 40 days. Never in the history of the Fed have we had that kind of a deflationary impulse 8 days before a hike. So just within the last 2 months, we've got this incoming data, and we have this, what I think is the bellwether of the economy, telling us
there's a problem here.
There's potentially a problem, right? And the real question is it supply-driven or is it demand-driven? It's demand-driven. Oh, my God. Like, it's funny, if you just kind of go query up, Goldman Sachs Commodity Index is down 15% over the past 40 days, and you go just look at those times through history, you find it typically is happening during cutting cycles, not hiking cycles. So, so this is different this time. We are hiking with this really contemporaneous set of very important data telling you, watch it, because you could be hiking at exactly the time you should be cutting. And if the only other times we've even been close to this was 74. I think the GSCI was down 11%, 97, and then December of 2015. So in 74, they hiked us right into a recession. In 97, that was one hike before we ended up getting into 98 and all the problems associated with that. And then in 2015, that was the first hike. Right. We went to 50 basis points, and we were on pause for years. So the one thing that I would say is there's a high probability that this hike will be, assuming they hike, will be one for the last one for a long time.
So you don't think they're going to hike in 2019?
No. I don't think they're going to hike in 2019.
Really? I mean,
no.
But by the way, the market still expects them to hike in 2019.
There's 20 basis points. It's not that much priced in. But I don't think they're going to hike, no.
And what do you think the chances are they don't hike in a week?
Oh, I think they'll probably hike. Again, there's so much momentum, and central bankers, by definition, are so conservative, and for them to change that quickly would require this unbelievable change. Right. The mindset, and look, you know, so on the one hand, we've got this fact set that we've never seen before, hiking into clear deflationary signals coming from the commodity complex. So let's say, okay, I don't think they're going to hike in 2019. So now let's look and say, what happens if this is the last hike? What happens?
Are we off to the races?
Well, so we've got 3 episodes to look at. We've got the end of the, when I say episodes, long hiking cycles, so I throw out 97, long hiking cycles followed by a termination point. So that gives us 95, that gives us 2000, 2006. So those are the last 3 modern day hiking cycles. And when they ended, they were generally speaking great times to buy the stock market. Within a month or so, the stock market was off the races. Right. So we've got, if you just thought, okay, this is going to be like last time, you'd want to be thinking about, in this turbulent period, buying stocks, because history would say 95 we exploded. 2000 we at least went back and retested the highs. They kind of, I think they stopped in May or June, and we were back and retesting the highs in October. And then in 2006, we went on for another 20-25%. Right. We went all the way up until October 2007. So modern day history would say, if this is the end, we've got to get ready for a big rally next year. So is your gang
that's behind me and around us, are they positioning themselves, are you guys buying right now amidst all of this?
Well, and again, on the other side, all of a sudden we've got them hiking into this deflationary impulse, which, if you remember December 2015, we had that horrific January of 2016, 74, we got annihilated. Even 97 after they hiked, we went down. So you got kind of two, if I'm just looking for historical analogs, I've got...
So which one are you betting on?
Well, that's why I said I think 10 up, 10 down. We're going to be both sides, because I don't necessarily know just yet.
But then what do you do about it if you're going to be 10 up or 10 down?
Well,
you just play the volatility.
I'm going to buy the hell out of it 10 lower for sure. To me, that's an absolute layup. The difference between now and, say, December 2015 is the market's deleveraged so much, right? We probably, if you think about all the buybacks, which we're going to have next year, which is, I can't imagine that sometime next year we won't be up 10% in the year, 10 or 15% in the year. I can't imagine, because we still have the same buybacks we had this past year. The difference is we're walking in to next year completely, totally deleveraged. And so, I mean, if we're being honest, you know, markets a lot of times it's just about herding cattle.
But you've also talked about the whole system being over-leveraged, talking about deleveraged.
Yes.
How much do you worry about that?
So again, again, that's why I think we can be both sides. We probably are sitting on a big global credit bubble, and I hope I'm not underestimating the potential negative impact that popping that bubble. What's so interesting about this hike is that this one, you're seeing the problems coming from it, or the consequences of it. You're seeing it where the bubble's the greatest. You're seeing it in China domestically on the private side. You're seeing it in Italy, who has a credit bubble in terms of their public deficits, their public debt. So we're seeing this hike playing out in the areas of the greatest credit vulnerability, the biggest bubbles.
We got to run. We're going to hit two things real quick. China trade. How much do you think that's impacting the market?
I'd say there's an emotional aspect of it that had a huge impact. No doubt about it, and clearly it's had an impact domestically in China and popping their credit bubble, which is having ramifications. So yeah, it's a big deal. It's I'd say 50 China, 50 the Fed.
Okay, we're going to leave the conversation there. Paul Tudor Jones, thank you. Congratulations on the Just Capital rankings today.
Day of celebration. Let's talk about all these great things they're doing.